We want to go over the first quarter results for the portfolios. All portfolios were up in March, and they are up on the year. We're going to go over those. The strongest portfolio is the 200K portfolio, 40 strategy portfolio, and we've been talking about this. And these are the results through yesterday, March the 31st. And this portfolio is in a 33.1750 drawdown. That means it's off. That's how far it's off its equity peaks, most recent equity peaks, and you can see how this drawdown curve works. The zero line means it's at an equity peak, and right here it made an equity peak, and you can see the pullback. So right here it made an equity peak, and it's pulled back here. It's down today, so it could be getting into that sweet spot, 5 to 10K drawdown, which would be a good entry point or a place to buffer. You want to buffer any worst case drawdowns by starting on a drawdown or adding to positions on a drawdown. So if you have 200K you want to allocate to a portfolio like this, you can start here. If you have 400K and you start here and it goes through run up and then it goes through another drawdown, then you can add another one if you have the capital to do so. Highly recommend. You know, this has 234K as the requirement, and that is the maximum margin if all strategies took a net position plus the max drawdown. So if you're in a drawdown, you can decrease that by the amount of drawdown, but you also have to consider that we never come close to trading all strategies in the same the net positions in the same. So 200K would suffice. You know, if margins massively spike, it might be a little more challenging to trade this. I don't anticipate that will happen anytime soon. And so even if margins spike, not all strategies trade at the same time. You can almost work with half the margin requirement in most cases, but it's good to be on the safe side and have enough to cover that margin plus worst case drawdown, and then start in a worst case not in a worst case drawdown, but in a drawdown to buffer, you know, any technical errors you may have if you're trading this for yourself, and if it does make a worst case drawdown. And then you see, I always anticipate these portfolios to make worst case drawdowns as volatility increases, and so you have to be able to weather those, and that's the best strategy to do that. Look at the other portfolio results. All 78 is up 29K on the month. It's in an 18,930 drawdown. It's kind of gone sideways on the year, so it's up. It started the year in a bigger drawdown, but it's up on the year and it's up on the month. All strategy access shortlist, the top 51 strategies we picked from the first list of 78 going into the year with a lower drawdown. It's in a almost a 10K drawdown from its most recent equity peak, but it's up 13K on the month and it's up 15K on the year. And then these 51 with the top 7 new strategies that I picked, it is $2,000 from its most recent equity peak, up 31K on the month, up 44K on the year. And you can see this one right here. Here is an example of how a portfolio makes a worst case drawdown as volatility increases. So you've got to be able to weather these. This one made this worst case drawdown, and then it bounced back, and it's had a good year. So we've had some more volatility this year, additional choppy volatility with the NASDAQ strategies, and so portfolios like the 200K portfolio only have 4 NASDAQ strategies, so it's been more solid. It's weathered the drawdowns better. Here is the stock index portfolio, 4K from its most recent equity peak, up 18K in March, up 11K on the year. It had a tough start as NASDAQ volatility was very strong in January. This has NASDAQ, and you can see this one made a worst case drawdown at the beginning of the year also. You have to be able to weather those. Expansion and continued volatility and chop, and so as prices go higher in markets, ranges will be bigger, and so I think we could be in a spot for markets to be less choppy, or for at least the NASDAQ is chopped so much, looking for a cycle to be less choppy, and that could work to our advantage as well. We've gone over the 200K portfolio. You can see how consistent that is. Once again, it only has 4 NASDAQ strategies, and so that's kept us out of the chop, kept this drawdown curve very cyclical in nature. I like this drawdown curve. And then we have a lot of diversity here as well. And so the 50K portfolio is a smaller version of the 200K portfolio, and it is 69.35 on the month. Too good. Started January tough, and so but up on the year 8K, and it's pretty good for a 50K account. It's in a 25-20 drawdown from its most recent equity peak as of March 31st. And so we've talked about other options for this, trading this with the E-mini S&P instead of the NASDAQ. And you can see the drawdown curve here as well. So that's the 50K portfolio. Let's look at the micro stock index and micro gold portfolio. This has come down here. It's just kind of gone sideways at this point. NASDAQ chop has really affected this, and it's come down here and stayed down here. It is up on the month because it was down here in these drawdowns, and it's bounced back a little bit from those drawdowns, but it's up 1961.25. Yesterday was a big day for this one. It was up about 11:30 yesterday, and so which is what it's up on the year. So going as of yesterday, it was flat on the year, and then yesterday's gains put it up. And so this one struggled the most, the micro stock index and micro gold portfolio, simply because we have so many NASDAQ strategies, and it just trades the NASDAQ and the gold. And we've gone over a potential update for this that includes trading the potential update for this at the right time. We talked about how this is the new portfolio. We have to time it. I'm waiting for a bit of a bounce. We're at the beginning of a new month and new quarter, so sometimes things change, and would like to give the current micro stock index and micro gold portfolio a little bit of a chance since it's had such a tough time and cycles change. We don't want to get out and then it go in our direction and we miss these. The potential is still there for the NASDAQ strategies to do really well. And so the potential update, though, is to trade on the micros the strategies you see in this list right here. You could trade the micros on the E-minis, the E-mini S&P, E-mini NASDAQ, trade those on the micros, and then trade the gold strategies on the micros. And you know, it's hard to trade it on the silver and soybeans, because if you're just trading one micro, the silver, E-mini NASDAQ, and gold are 1/10 the size. But if you trade silver, they're only 1/5 the size. Soybeans only 1/5 the size. Crude oil, their mini contracts are 1/2 the size. So it doesn't really match up as well. And you'd have to basically trade a crude oil. You'd trade one mini of crude oil would be equivalent to trading 5 micros in the gold, E-mini NASDAQ, and E-mini S&P, and about 2 to 3 silver and soybeans. 1 natural gas mini, that would come close to matching up, but that'd be about half of the 200K portfolio if you did that. So the markets that have the smallest contracts and are the most liquid are the E-mini S&P, E-mini NASDAQ, and gold, and that's why we have a micro portfolio specifically for those, is because they have 1/10 contracts and they're pretty liquid. So you could potentially, we've gone over this, you could trade the micro version of the strategies in the 200K portfolio in this list. So right now, officially, the micro stock index and micro gold portfolio will remain the same. We talk about cycles that happen in the market, and so this is down. I want to show you the SR counter trends and how that cycled in 2020. The SR counter trends, let's go over those. SR counter trend portfolio is just the SR counter trend 2, 3, 4. And so this portfolio is set up, did well January through March in 2020. And then it didn't do well the rest of the year. A lot of V patterns in the markets instead of waves, but look how it's rebounded in Q1 of 2021, and we anticipated that. We said that we anticipated that it would, and it came off this worst case drawdown. It made the worst case drawdown, and then it rebounded. And so we don't want to get out at the bottom. We want to give the current micro stock index and micro gold portfolio a little bit of a chance to rebound. But we have our new portfolios set up that we talked about transitioning to. So you could trade either one if you're a micro stock index and gold portfolio subscriber. These also work on the stock index and gold. These are basically taking the stock index and gold strategies and 1/10 of the results of those by typing in 0.1. Sometimes the trades can be slightly different between the micros and the minis. So that's a detailed update on the portfolios through Q1 2021, how to think about these, what to anticipate, and the current performance for all of these.